Welcome back to the final round here on Yahoo Finance. Stocks closing in the green today with Dow, S&P, and NASDAQ all posting gains. Dow closing up 165 points during today's action, with the S&P 500 trading at its highest level in just around 5 months. For more on the market action, I want to bring in Scott Wren. He's with Wells Fargo's Investment Institute. And Scott, let's just start with earnings season. We've got a slew of names reporting after the bell today. What are your thoughts on earnings season so far? And then with so many companies pulling their guidance, I guess, how much weight do you think investors are giving to these results?
Well, Sean, I don't think, coming into this, in my personal opinion, I don't think really investors are paying a whole heck of a lot of attention overall to earnings. I mean, they're probably, earnings are probably going to be down 40%. We've had about, 68, 70% of companies beating so far. Normally for me, I mean, earnings are what happened in the past. It's a lagging indicator. It's the last thing that happens. Usually you pay a little bit of attention to the guidance, but as you mentioned, you have a lot of companies pulling guidance. Plus, those that are giving guidance are basically very cautious because they're uncertain as to what lies ahead as well. So, I would say this quarter relative to the first quarter, you're getting a little more in terms of the commentary and the outlook, but you're not getting much more. So I think investors are looking past this. Individual companies, which you guys are talking about, these, they're going to get big ups and downs on beats and misses. But overall, the market's not paying a whole heck of a lot of attention to second quarter earnings, in our opinion.
Scott, sorry. I noted that you said that we are in a deep but short recession, should be out of it pretty soon. Wow. I mean, I guess you could argue the flip to that this is going to be a long slog. What's your thesis to support that we're going to get out of this? I mean, I know you're not calling for robust growth, but what's your take?
Well, I think it is a longer slog, and I think right now, for us, we were looking for the S&P 500 to end around 3250 at the end of this year. So, based on today's close, we're a touch above that. So for us, stocks are fairly valued, maybe a little bit ahead of themselves, maybe anticipating less volatility than we are, because I don't think you're going to go straight up from here. While we're expecting decent medical news on the vaccine and treatment front, we're expecting better employment news. We don't think we're going to go back into lockdown, and we're going to see some ebbs and flows in terms of 2 steps forward, 1 step back on these reopenings. But I think the market might be a touch ahead of itself, not a lot ahead of itself, but we want to play it for a recovery, for a good third quarter GDP-wise coming out of the hole, for a good fourth quarter, and then about 3% growth next year, which I think the consensus is about 4%. So we're not quite as optimistic next year, but certainly we think we're going to be out of this short but very deep recession.
Hey, Scott, Rick Newman here. So you said before you don't think the market cares all that much about earnings, which we're hearing, this week, next, and then the following week. Let me ask you about the Fed. I mean, that's a big story here. The Fed is essentially carrying the market to some extent. How much depends on whom you ask. But how much of where the market is contingent on the Fed continuing to support asset prices and liquidity and everything else?
Well, Rick, I'm a big believer in don't fight the Fed, and that's just something that's going to drive the market. We know the Fed is not going to do anything with interest rates for a long period of time. They'd love to see a little inflation. We're not going to get much of it. They'd love for the economy to heat up. We're probably not going to see a lot of heat, at least through next year anyway, in our opinion. So the Fed is a big part of why we were here. Why we've come up here, why we're rallied 45 or 47% off that March 23rd panic low. So that's a huge factor. We know that's in place. Where the uncertainty lies is just what's going to happen with the virus. Are we going to see a vaccine? How soon is it going to be? How soon are people going to come out and not hide and go out and spend money and get back to sort of normal by the end of the next year, over the course of the next 12 months.
Hey, Scott, speaking of the Fed, I mean, you had a pretty interesting note here recently because you were talking about the Fed put, and in that you were exploring the question about whether the Fed should be, I guess with the Fed, I should say, taking aggressive steps like lowering interest rates to zero every time the economy stumbles a little bit. While it's necessary, like you said, to prop up the economy, you also make the argument, though, that it could be detrimental for future growth. So I'm just curious if you could explain that reasoning and then what could happen here going forward.
Well, I think that, Shauna, I think that, should the Fed step in when we have a big, basically a financial emergency like we do right now? I think they should. But in most recessions, if you look back over the last 60 years or so, they tend to be a lot more mild than what we're seeing now. And it allows excesses to be washed out of the system, inefficient companies to go out of business, creative destruction, that type of thing. And so I think right now the market is counting on may be a strong word, but as we look down the road, every time the market stumbles, is the Fed just going to drop interest rates to zero almost immediately just to get some growth going? And the problem is that builds up excesses. People take on debt. Clearly, at least in my mind, one of the reasons why monetary policy hasn't worked as it typically has over the last 10 years is the level of debt that's out there. So, there's a ton of debt out there. You cannot force people to go out and buy and spend. And that's what we've seen the last 10 years here. So I think we're in a potentially dangerous situation, or at least a concerning situation, where the market expects the Fed to react very aggressively. Every time we get a little bit of a dip in the economy, the inefficiencies don't get washed out, and the debt keeps building up. So those combination of things have me concerned as we look forward. Maybe not necessarily right now, but certainly in the years ahead.
All right, Scott Wren, Senior Global Market Strategist at Wells Fargo Investment Institute. Always great to have you on the program. Thanks so much for taking the time to join us today.
All right, thanks, guys.